Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we're going to be talking about the average true range. And the average true range is an indicator. It will help us know how we can leverage on it to create a powerful day trading strategy. The ATR, also known as the average true range, is one of the most valuable yet underutilized tool for measuring the market volatility and managing your risks effectively. Whether you are struggling with setting proper stop losses, finding optimal entry points, or determining the appropriate position size, this ATR strategy will provide you with a systematic approach to day trading. So why not stay until the end to learn how this versatile indicator can transform your trading performance and help you adapt to changing market conditions with confidence. So we start by understanding what the average true range is, and this is a technical indicator. Unlike other indicators that predict price direction, the ATR focuses solely on measuring the degree of price movement or volatility in the market. At its core, the ATR calculates the average range of price movement over a specified period, typically 14 period. That's the standard setting for the ATR indicator. The calculation takes into account the greatest of the three measurements. Which three measurements? The first measurement is the current high minus the current low. The second would be the absolute value of the current high minus the previous close. The third will be the absolute value of the current low minus the previous close. Remember, higher ATR value usually indicates an increased market volatility and large price movement, while low value suggests there is a decrease in the volatility and small price movement. This information is crucial for day traders who need to adjust their strategies based on the current market condition. So for day trading purpose, many traders adjust their settings 14 period setting for a shorter time frame. To a shorter time frame, you can also use 5 or 7 periods to make the indicator more responsive to recent price action. This adaptation makes the ATR particularly valuable for intraday decision making when market conditions can change rapidly. So since we are making use of 15 minutes time frame, we can use the 14 period on our ATR. So let's incorporate this into our trading strategy. Let's see how we can incorporate this to our trading strategy. The first step is to identify the volatility based entry point. You have to identify your volatility based entry point. You look for a period where the ATR is declining or flattening. This consolidation phase often precedes significant breakout. So when the market is trending, is consolidating, when the ATR is declining, flattening, it usually signifies there is a consolidation. So as we can look at this area, you can see it is flattening at this area, is declining at this area, and you can see there is a little bit of consolidation in this area. When price begins to break out from a consolidation pattern and the ATR starts expanding, this signals a potential trading opportunity. Now let's get a better example to understand what we're talking about in the market. We look for where price is consolidating and we wait for, okay, this is a perfect example. At this area, we can see that price was consolidating at this point. When price consolidated at this point, you can see the ATR was flattening at this area. The moment price expands, you can see there was a spike in the ATR, signifying that the volatility in the market was stepping in. You can get better examples from our chart. I don't know what's going on with my chart. Sorry. So at this point in the market, you can see there is a consolidation followed by a flattening in the ATR indicator before we saw a spike, and we can see that price spiked and broke out of this range to the downside. This is typically how you can look at your ATR indicator. The second step is to set your dynamic stop loss placement. One of the most valuable applications of your ATR indicator is setting an appropriate stop loss based on current market volatility. So if you want to take a long position, the best way to take a long position and place your stop loss would be you would place your stop loss at your entry price. Let's assume we enter this trade at this area. This is just an example on how to set your stop loss. If you enter your stop loss at this area, you would have to write out your entry price. We are entering at 1.13376. This 1.13376, you subtract it from the ATR value at that point. At this point where price we entered, we can see the value on the ATR indicator. You can look at this area, you will see the value. So where we entered 1.13382, the value is 0.0016. You subtract your entry price by this ATR number. In order to get a more befitting stop loss, you can multiply this number times 1.5, then you subtract whatever you get from the multiplication from your entry price, and that will give you a good stop loss placement on the chart. Now for a short trade, it's the same thing. All you need to do is your entry price. What's happening? Okay, sorry about that. So for a bearish trade or for a sell position, all you need to do is your entry position. Let's assume we entered from this area at this point. You just need to know that from your entry, wherever your entry is, your entry value is where you entered was at 1.14142. You add this you would add this number to your ATR number at this point where you entered. So your 12147 plus your 0.00106. When you add this, it will give you a good area for you to place your stop loss. Or for a better stop loss, a wider stop loss to give your trade enough room, you can multiply this value you see there at your entry price times 1.5, then you add it to your entry value at this area. This would help us set a better stop loss. Now your step 3 is to always establish a calculated take profit target. You can always use a take profit target of you would add your entry to 1 times the value at the ATR. So all you need to do is at this level where you entered, you add this level to your ATR value times 1. This would help you get your take profit level, your first take profit level, in case you need a higher take profit level or a longer take profit level, which some people call take profit 2. You can use the entry plus 2 times the ATR value. So the entry plus 2 times the ATR value to take your second position trade. Or you can always incorporate your trailing stop loss. Now this structured approach allows you to secure profits while trading, giving room to develop into a larger move. I repeat, this is structured to allow you to secure profits while giving trade room to develop into a larger move. So trading stop loss on the final portion of your position would help capture extended trends when they occur. The step 4 is to apply volatility-based position sizing. You can always calculate your position size still using your ATR indicator, and you can calculate the position size by your amount you want to risk. The amount you want to risk, let's say I want to risk $50 of my account. I would the amount I want to risk, which is the $50 divided by the multiplication of your ATR value times your stop loss multiplier. That will give us a position size, or you can still make use of your position size calculation as the case may be. This formula would ensure that you are risking a consistent percentage of your account on each trade, regardless of the market volatility or the instrument you are trading. That is why we calculate or we incorporate the ATR when using this indicator. We can use it to set our stop loss and take profit level. That's why we can use this indicator to get those values. The step 5 is to always implement the ATR exhaustion strategy, meaning when price moves significantly beyond the average range, it often becomes overextended and prone to a reversal. The ATR will help you identify a potential reversal point. So when you notice that price has moved significantly beyond its average mean, always expect a reversal in price. And as you can see at this area, when ATR was showing an overextended move, you can see there was surely an exhaustion in price. This is how price moves. So you have to look for price movements that exceed 2 times the daily ATR within a single trading session. So these exhaustion moves frequently present a counter trend opportunity. So you always keep this in mind when trying to get a good entry position and when you are observing your chart. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. And if you found this video helpful, do not forget to like, share and subscribe. Turn on your notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.